Well, welcome everybody to the Local Business Growth Lunchtime Webinar Series 2022. I'm Adam Bude from Authentic Sales Training Academy and excited to be co-hosting this 6-week live and interactive series with you all on how to not only survive the potential rough waters that are coming, but to actually thrive beyond and through and beyond those times. We put together an expert panel of industry leaders and business advisors from the banking and finance world, sales and marketing world, and so much more. Each week, we'll be hosting a quick 20-minute session covering key topics of interest on how to restructure for future business expansion, growth, and success. We've got Matt White from MJW Advisory, who was our featured presenter last week. Today, we have Phil Imroff, franchise owner from Bank of Queensland Robina branch, Glenn Bossy from 2020 Financial Services, Mark Grant from Costless Payment Solutions, and of course the one and only Nick Cree from SmashGo. At the end of each session, we're going to open the lines for Q&A, so make sure you have your questions ready and take note on which days which speaker will be presenting. So if you've got anything specific that you want to ask, absolutely bring them to the call. As I mentioned, today's expert speaker is Phil Imroff from Bank of Queensland. Phil's been a franchise owner of BOQ Robina branch for the past 19 years. He and his team are passionate about their customers and their community. They're committed to delivering exceptional banking experiences by building relationships and understanding your needs, whatever they are, whether it's in business banking, everyday accounts and savings accounts, low interest rate home loans. There's nothing we like better than helping our neighbour. Great philosophy. Our business has grown on the back of service, and we provide the referrals that we receive as results. And we back the service that we provide and the referrals that we receive as a result from our efforts. So, Phil, welcome.
Thanks, Adam. Hi, everyone. Appreciate the opportunity to have a chat. And as Adam said at the end of it, I'm happy to answer any questions. So the topics I was going to talk about today, so from a banking point of view, I've been in the banking industry 40 years in total. I was in NAB prior to joining BOQ. My background is business banking, from a lending point of view. And since I've had my franchise, I'd probably say 65% of my clients are self-employed. And those clients range from sole operators up to medium-sized businesses. And every one of those businesses has different needs. But from a banker's point of view, the things we look at are very similar, whether you're an individual operator or someone that's got a multi-million-dollar operation. So the topics I was going to cover today are what we call the 5 C's of credit. So that's capacity, collateral, character, conditions, and capital. The second topic was knowing your business figures and the reasons for variation or fluctuations in those figures. And that probably follows on a little bit from what Matt spoke about last week. And from my perspective, I work closely with accountants with my business clients, because we're both pretty integral to the success of your business going forward. And the third topic was why banks structure loans the way we do. So starting off with the 5 C's. So capacity being number one really comes down to your ability to service a loan. So going back some years ago, a lot of people thought lending was based just on security, and probably to a degree that might have been right. But then with the GFC, which was back in the 2008 sort of era, and then more recently with the Royal Commission, security is still important, or servicing is still important, but more so now than security. So a lot of people are still under the philosophy that if they've got good equity in their property, they can still borrow money. Unfortunately, the reality is that unless you can show from your tax returns that you have the ability to repay a loan, it's going to be very difficult to borrow money. There are lenders out there that will lend in what they call a low doc space, but they're the second tier lenders, and usually private lenders, and you do pay a premium for that. So, and every application, one of the first things we do when someone comes in is we complete a servicing worksheet, and we're looking for 2 years tax returns, the last 2 years trading, together with probably interims, depending on the time of year that you come to the bank. So, for instance, you might not have finished your 30th of June 22's tax returns at this point in time because you've got that lag period that the government or the ATO allows us. And in that case, we're looking at 30th of June 20, 30th of June 21, and then make an interim profit and loss for the year up to the 30th of June 22. And then the second topic that I'll talk about variations, I'll expand on that a little bit more. So with collateral, that's pretty straightforward, security. And I think I don't need to go into too much detail on that, but it's bulk of borrowing through any bank requires us to hold security in case of a second point of recall, if we can put it that way. The third topic is character. And then, so by character, I'm meaning the record, whether it be a director or a sole proprietor or partners. We're looking at the character of the person that we're dealing with, how long they've been in the industry, their record. Again, pretty straightforward. Number 4 is conditions. So conditions can be internal within the business itself, or external, which might be government, whether it be federal, state, local requirements. Environmental rules can affect some businesses and the way they operate. Compliance, the list goes on. And number 5 is capital. So by capital, it's just, again, a lot of people will manage their business from a tax perspective. It's a balance between what you pay in tax, and then if you have a requirement that you need to borrow money, getting the balance to show that you're earning money and you're retaining profits and things like that. You're not just draining it all out of the business to cover for future growth and your ability to maintain the business and keep going. Now, the second point is know your business figures and reasons for fluctuations and things. So when we ask for 2 years tax returns, one of the things we look at is whether your income's stable, whether it's going up, if it's going down, why it's decreased. And there's usually obviously good reasons why variations can occur. And we're asking for some, we ask a lot of questions when we're doing loan applications, and there's a reason for that, is that we're putting it down in the application for a third party who has no face-to-face contact to make an informed decision. So we've spoken about income, and then percentages. Depending on the type of business you may have, the cost of goods. So if you're a manufacturer or something, we look at trends, whether your cost of goods is stable, or if there's been variations, and again, reasons for that. And then you get into expenses. And there can be what they call one-off expenses, which might be legal bills, or it could be you had to make some major repairs or something like that to equipment or property. And we need to understand reasons for those variations. And the balance sheet, we're looking at information like what assets you hold within the business, retained earnings, as I spoke about before. And it all gets tied up into the picture that we put onto the submission. And we physically go through and we answer those 5 C's of credit in the submission that we put forward. And then why bank structure loans the way we do? So within your balance sheet, you have what they call current assets, current liabilities, and non-current assets and non-current liabilities. So the difference between the two, current is something that can be converted into cash or has to be paid within a 12-month period or the next trading period. And non-current is something that is a long-term, can be paid off over a number of years. And we tie the finance to that. So if you're looking at working capital, that is a short-term requirement. And it generally, when we're setting an overdraft, a rule of thumb that's been around for a long, long time is the overdraft limit usually represents about 10% of your gross annual turnover. And if you want more than that, there's other questions that need to be asked as to why. And it might be that some of that requirement working capital is not short term. It needs to be structured in a different format. And then if you're going to purchase assets, now property can be purchased over, if you're using the commercial property as a security, 15-year loan term. Whereas if you've got a residential property, we can extend that out to 25 years. And obviously that makes your repayment factor a lot more affordable. And then you have asset purchases. So with a lot of people will finance motor vehicles and also equipment. So if you're in a manufacturing type of business or specialised area, you might need specialised types of equipment, which we do quite a lot of, like I've done medical equipment, trucks, buses, as I said, a lot of motor vehicles, we do that. Specialised equipment that can be imported from overseas. That's all stuff that is, again, tied to the term of the life of the equipment. So with a motor vehicle, for instance, the longest you can have in one finance period is 5 years, and then you can have a residual balance after that. So some people may trade their vehicle straight away, or they might want to keep it and refinance the residual at the end of that. And the same can apply to any type of equipment. We just have to look, and the ATO provides a list of terms that certain types of equipment can be financed over. And then obviously with the depreciation rules these days, you can claim that immediate benefit, but there's still a useful life to the product. So I think that's probably really all I can briefly summarise without getting into too much detail, and happy to answer any questions.
Hey Phil, how are you, mate? I'll jump in if no one else has got a question. What's the current appetite, because different banks change it from time to time, as you'd be aware, with lending for property held in a self-managed super fund?
Well, property, so a lot of, we're one of the few banks that actually still do lending to super funds. And the bulk of what we do is, like, if you're a business and you want commercial premises, you can purchase them within your super fund. Now, the rules are slightly tighter in that when we use commercial security, they have what they call a loan to security ratio. So generally we'll go to 70% on a standard property, under commercial property, under like a normal everyday structure, but under a super fund it's 60%, and the super fund needs to have $400,000 in the super fund of assets before we'll look at it. So I guess that's come about. It used to be lower than that, but unfortunately, if hard times do come on and you don't have a lot of backing within your super fund, that's why they set the rule at 400,000, so that it's a size that's got some substance to it. Is that what you're asking there?
Yeah, certainly. And 60% still reasonably generous, I think. And I'll let the financial planners, Glenn, in the room talk about, advantages of purchasing property, particularly commercial property, in a self-managed super fund. But it makes sense if you're a business operator that's renting, you may as well rent it to yourself via your fund, right?
Yeah, we've done quite a few, and the bulk of them are for business owners. It's
good to hear that. Good to hear the BOQs are open to it, because a lot of banks shut their door because they don't understand the bare trust structure, etc.
That's right. Yeah.
Thank you.
Yeah, no, I've got quite a background on that. So.
Oh, good. Thank you, mate.
I've got a question too, Phil. Sorry for jumping in. Personal guarantees that small business owners will obviously, need to take in some cases. Why is that? And is there a way that any finance can be given without personal guarantees for small business owners?
And can I jump in on that? And just on the back of your overdraft comment, lend up to 10% of revenue, does that also require personal guarantees?
Okay, so the answer is yes, yes, and yes. So normally with personal guarantees, if you're a sole partner or sole proprietor or partnership, you're borrowing in your direct name anyway, so there's no guarantees involved there. But if it's a company structure or a trust structure, the directors of the company are required to give a personal guarantee, because they're the ones making the decision at the end of the day on how the business operates and the direction, things like that. So it's more or less, whilst a company is a separate legal entity, we want the directors to be directly involved in the lending and take responsibility for it. And guarantees from other parties may be that property is held under a trust, which is a separate entity to the entity that's borrowing the money, and you might have a guarantee that's come across from that third-party entity. Whether it can be waived, I've never seen it, the requirement for a director's guarantee being waived. It's pretty standard by all banks on that.
Can I just ask a question, Phil? Thank you for that answer. Regards to, unfortunately, a lot of people going through their separation or business issues in their 50s, for example. How's BOQ's approach to, you talked about home loans being 25 years. Does the bank still look favourable to someone in their late 50s to get a 25-year loan?
Again, it comes, two answers to that, Glenn. So when I was saying 25 years, that's actually a business loan if you're using residential security as security for the loan. So you can have a business loan up to 25 years. In some cases, we can go to 30, where home loans, the maximum term you can go to is 30 years. So to answer your question, APRA have set guidelines. So all banks have to lend within the rules of APRA, which is the government body that oversees the finance of the banking industry. And we have to work within those rules. So their basic guideline is that a person has to own their property, one property, by the time they reach 70 years of age or retirement. They don't want money that you would be receiving or drawing from your super fund or pensions being used to make loan repayments. That's for living expenses. So if you own just the one property and you've got no other investment properties or anything like that, your loan term is restricted. So if you came to me and you're 56 or something like that, in that age group, we would be structuring the loan or looking to be able to service it over a 14-year, maybe 15-year loan term. If you already had another property, so as your principal place of residence, and that was going to be paid, or you had good equity and it was going to be paid off by the time you're 70, and you came to me and you wanted to buy an investment property, that can be done over a 30-year loan term. The requirement is that one property is owned by the time you retire.
At 70 years old.
That's right. Or you have the capacity to clear all debt by the time you retire, whether that's by selling another a property or something like that would clear out all the loans. So it's just something that we have to, it's one of the things we have to put in the submission, age versus term consideration.
Sorry, Phil. So you'll consider, you know, the capital appreciation of the asset over a 14-year to 70, you know, with the requirement to sell that prior to turning 70. There's obviously capital growth. How do they factor that? Do they factor it into the term of the loan contract?
Well, it would be, no, they don't factor it in. It's just the loan term is set for, let's say 15 years. The debt has to be extinguished by the time that 15-year term is up. If say they, because they've got to still have a place that they live in by the time they reach retirement. Let's say, for argument's sake, someone has owned a property and it's gone up in value and it might be worth $1.5 or $2 million or something like that now. And they said to us that they're going to downgrade and buy a lower price property for retirement or something along that lines. We can ask the question on whether they'll accept that to clear out the debt, especially if it's only a smaller debt level in comparison to the value of the property. If they were saying, oh, we're going to borrow 70% against that property, it makes it harder to argue that you're going to clear it out within the term. But if it was, say, 200,000 and they were going to downsize and buy that's something you could argue to get a policy exception.
Phil, I've got a question for you. In the event of a business owner not having security available for whatever reason, what's the Bank BOQ's viewpoint on unsecured business facilities?
Difficult, to be honest, Mark. There is a limit that we can provide assistance to, but it's only going to be very small. And it comes back to, and that's what I was talking about, the capital position of the business. Again, if you're not keeping retained earnings and the net asset position or owner's equity position in the business is very minor, there's nothing there for the bank to hold any stead in. So again, that comes back to working closely with your accountant in not just working from a tax perspective, looking at every aspect when you're doing tax returns and things like that.
Thank you, Phil.
Phil, is it just fixed and tangible assets, mate? Do you get involved in margin lending schemes for share portfolios, etc.?
Margin, like what, in buying a share portfolio?
Yeah.
We don't have a margin like we used to have a margin loan facility. Now we just generally will do a home loan for investment purposes for that. I guess that was quite a number of years ago that changed, because after the GFC especially, and a lot of people got caught out by margin calls and that sort of thing that came. Does everyone know what a margin call is? So when you're buying shares and you use a margin loan facility, it's based on the value of shares on a particular day. And if the share values go down and the overall exposure on the facility is too high compared to the value, that they do what they call a margin call, you've got to put money into to bring it back into the margins, acceptable margins. So we don't do those type of loans anymore. It's more just against security.
Phil, the number one topic that you spoke about was, knowing your business figures and the reasons for variations / fluctuations. What would be your, I suppose, recommendation, or probably a suggestion is a better word, for a business owner that's finding, let's say the economy does go in a direction that they didn't anticipate in, and that has a direct impact on their business revenue, cash flow, etc. More often than not, business owners won't do anything until all of a sudden it's too late. So what would be your suggestion on what they can do if they are starting to see variations that are abnormal, that are out of their control? What can they do to sort of safeguard themselves, future protect themselves, and future plan, in your opinion?
I would suggest that they have a very good relation and close relationship with their accountant, and that those meetings that Matt suggested last week about probably getting together at least every 6 months, maybe quarterly, depending on the type of business and the size of your business, are vital, especially if times are going to be uncertain. And usually people have a fairly good idea what's happening over the next 3 to 6 months, and they can, like, there are ways, if you do have to make some hard decisions, you've really got to be on the front foot. If you leave it too late, it usually is too late to make those difficult calls, and then it's a battle uphill. As a banker, we can definitely assist if we need to restructure facilities. So sometimes it can be, one of the things I didn't mention is if you're buying say you bought a business that's in a shopping centre or in leased premises, the loan term is structured to the term of the lease that you have.
Yeah.
At the end of the day, you don't want a debt hanging over your head and the business, say the landlord said, well, sorry, we're not renewing your tenancy. You have to relocate the business, or in sometimes worst case scenarios, the business is no longer there. It's not worth anything. So again, a vital reason to have your facilities structured according to your individual business. But we do talk to our clients, and I've always got an open door policy on talking to people. And one of the things I do suggest to people, when they do come in and see me, is go and talk to your accountant or other specialist areas to get other input. And if required, the bank can defer payments. We can convert a loan to interest-only payments for a short period of time, but we would want input from the accountant to say that there's light at the end of the tunnel as well before doing that.
Yeah, and that input too, Phil, that's tricky and trickier, getting tricky and trickier, and certainly not, good branded financiers such as Bank of Queensland, but some of those third parties, they ultimately ask the accountant, and they word it in such a way that it doesn't quite say, guarantee serviceability, but it certainly comes across like that, and we just refuse to do it, and the broker of those third party or bottom tiered banks make out as though accountants should be happy to do so, but you're almost effectively potentially co-signing a loan, and So just be mindful of that. If you're borrowing from banks such as the Big Four or Bank of Queensland, typically your accountant's happier because you guys don't put that rubbish on us. But certainly all the high interest, mid lower tier banks, it happens more and more, and they well know that we don't have a credit license for a start, and then they also know that we're not in a position to guarantee the serviceability of the loan, but they try it on anyway. So heads up, guys, if a lender's asking you to do that of your accountant, they're probably not the right lender, and maybe you shouldn't be entering into that anyway.
Yeah, we're more working with the accountant to. It's it might be that we require a cash flow projection or something like that going forward, especially if the business is restructuring to get through a difficult period. And that's where you can come in as a professional to assist because a lot of business people, that's not their expertise, and they need support to prepare the documents that the banks are going to ask for.
Yeah.
Thank you for that. Thank you for that, Phil. Just one question. I noticed at the moment, a lot of people haven't factored in increases in interest rates, and if we go through a recession or downturn or whatever, downturn in business, with the rise in interest rates, has caused a number of people a number of headaches. What's the BOQ margin above the current interest rate when they're doing repayment calculations?
Okay,
Cash
so
flow.
all right. So there's two answers to that one, Glenn. APRA require all banks to add a margin of 3% onto home loan assessments. So when we're assessing a home loan, if, let's say, for argument's sake, the rate is 4%, just to pick a figure, we're assessing it, their capacity at 7%. With business loans, that safety margin is 2.15. So business lending doesn't fall under the same strict criteria as home lending because of the consumer credit code and APRA and that sort of thing. We've got a little bit more flexibility there. And as I said, we can rely, a cash flow projection, we can rely on some negative aspects with the right input from the accountants, cash flow projections and things like that, change of business direction to get an approval, whereas with a home loan, you don't have that flexibility.
Do we have any questions from any of our guests?
Well, yeah, well, I guess I'm keen to hear Glenn in a couple of weeks. I think we've got a Queen's Death public holiday or something for the next one, but keen to hear your comments, Glenn, on the back of Phil's commentary just around the current state of the market, given that the share prices plummeted during the week.
Yeah, last night, yeah, I saw that. So I'm happy, if there are any people out there that want to just sit down and have a review of what facilities they've got, doesn't necessarily have to be Bank of Queensland. I offer obviously a service where I'll sit down and talk and go through your current situation and whether we can provide something more attractive. Because I've been here 20 years now, not planning to go anywhere for a long time as well. So you do have that relationship.
So from my point of view, I'll talk about it more in my speech, but it's an incredible amount of people, business and personally, never review their home loans or their business loans, and can be costing them a lot of dollars. So I'm always highly recommend that you review your loans and see people like Phil, because in the space of a couple of hours, you can wipe out thousands and thousands of interest year after year.
Yeah.
Well, and just on the back of that, and I appreciate we might need to wrap up, but Phil, what's your comments then if there's, get out penalties? Is there any way to get around get out penalties? So, for example, you're on a fixed rate or a specific facility that, if it doesn't go to maturity, then there's an early exit penalty?
Well, the general rule is if it's variable, there are no break costs. Variable rate loans, you just pay the interest up to the day you break the loan. I'm talking normal, like bank loans. Some of the private lenders, yes, they can have penalties, and unfortunately you can't do anything about that. Fixed rates are probably the only time you do have break costs. And the general rule of thumb with that is if you're in a fixed rates and interest rates have increased, so the bank can re-lend the money out at a higher rate, the break cost is next to nothing, if anything at all. If the rates were going the other way, yes, the bank would be losing money and they pass that cost on. So there's no way to avoid that. Equipment finance, as we're saying about cars and equipment, if you break those contracts, there are exit fees involved in that. But generally, there's very few reasons to break an equipment finance contract anyway, unless you sell the equipment or something like that, and you don't have much choice.
Can I just add a quick thing to you, Matt? We actually decided to do next week as well.
Right. Okay. Very good, mate. Yep.
Yeah.
Excellent. Well, thanks so much, Phil. I think the biggest thing that I get out of today, obviously, you've got so much experience, which is really important for anybody that's looking for advice. You really do want to know that you can trust people that know what they're talking about. But more importantly, from what I've witnessed with our interactions together, that relationship building that you do, that care for people as actual people, with or without them being a customer, that people care first is a massive difference for anyone in the banking sector, because you are treated as a human, you're not treated as a number. So I highly recommend anyone that's looking for a real relationship with, no different to your accountant. I mean, people do not have that relationship with their finances. We might have brokers that we go to and we trust to get us a good deal, but taking that one step further and building that bond is something that is quite unique and is a really big point of difference. So I appreciate that. I'm sure others will too, and appreciate.
And that's for business people, that is more important. Home loans can be slightly different in that it's, people might change their property every 7 years, and it's not really. But for what we've spoken about today, it's vital for people to have someone they can talk to and with business, because conditions change at a drop of a hat. So,
well, and the other thing that I see too, and certainly not those that you've got a long-term engagement with, but with new engagements, and they're starting it in business, so they're looking for fair prices. But I often caution people not to take the cheapest price of your bookkeeper, accountant, solicitor, broker, financial planner, because ultimately when the mud hits the fan, you've got no one to come together. So typically, if you've got a good relationship with a broker, he's got a good relationship with a solicitor, he's got a good relationship with a financial planner, and we all come together. But if you're shopping the cheapest advice, invariably you're left all by yourself, and you're going to pay more for it when you need someone to come in and jump in when you're in trouble. So
yeah, agree. If you're shopping around a price for specialized service, you're shopping for trouble. No, great input, Matt. So yeah, Phil, amazing. Thank you for that. Really appreciate that. Next week we've actually got Glenn from 2020 Financial Services, who'll be building upon what both Glenn and Matt have shared with us in recent weeks. And topics of discussion next week will be recession and downturn offers the opportunity to actually build wealth. Really cool topic that I'm looking forward to, because in most cases, when there is a recession or a downturn, people are doom and gloom, as opposed to looking at the opportunity that the current economy provides. More millionaires are made in a downturn than in any other market. So that'll be a hot topic. He's going to be talking about the importance of protection and the importance of transferring wealth at the right time to the right people in a effective manner. So if you know anybody that can really benefit from those key points that Glenn will be sharing next week, absolutely share the invite link to them. So with that, guys, I hope you got some real value. Thank you again, Phil. That was amazing. And we look forward to seeing you all again next Thursday at 12 p.m. Australian Eastern Standard Time. Make it a great day, everybody, because you all deserve it.
thank you, guys.
Thanks, guys.